Investing can sometimes be simplified into a handful of straightforward guidelines that everyone may use to make money, but achieving success might involve both doing and not doing things. In addition, the procedure is complicated by your emotions. Although everyone is aware that you should buy low and sell high, our disposition frequently causes us to do the opposite. Investors disagree on a lot of things, but they do concur that success in the market requires a consistent plan based on a set of guidelines. Consider your first few years as an investor. If you're like most people, you entered the market with little to no market expertise. The best place to start, if you don't already have your own set of properly thought out investment guidelines, is by asking those who have succeeded in the field. Good day and welcome to Stealth Wealth. In this video, I'll teach you the most important investing lesson anyone can learn. Stay till the end for the best and easiest investing tip out there. Invest in yourself and don't forget to tap the like and subscribe button at the bottom of the video. I'll like you if you do. If you've never created a financial plan before, take some time to sit down and honestly assess your current financial status before making any investment decisions. Establishing your objectives and risk tolerance, either on your own or with the assistance of a financial expert, is the first step to effective investing. Your ability to profit from your investments is not certain. However, if you're aware of the realities around investing and saving, and you follow through with a wise plan, you should be able to achieve financial security over time and benefit from sound money management. It may be easier for you to stick to your plan if you're aware of your financial objectives and the length of the time that you're investing over. For instance, you might be less likely to give in a temptation if you have a long-term objective, such as saving for a retirement that could be decades away. The next lesson that I'll share with you is to examine your comfort level with taking risks. Every investment has some level of risk. Before investing, it's crucial to realize that you can lose some or all of your money if you plan to buy assets such as stocks, bonds, or mutual funds. The money you invest in securities is often not federally protected, unlike deposits at FDIC-insured banks and NCUA-insured credit unions. Your principal or the money you invested could be lost. Even if you buy your investments through a bank, it's still true. The potential for a higher investment return is the reward for taking on risk. If you have a lengthy time horizon for your financial objectives, strategically choosing riskier asset classes like stocks or bonds would likely yield a higher return than limiting your investments to safer assets like cash equivalents. However, for short-term financial objectives, investing only in cash assets may be beneficial. The main worry for people who invest in cash equivalents is inflation risk, which is the chance that prices will rise faster than returns over time and degrade them. Make sure you thoroughly investigate any investment before investing your money in it so you know exactly what is involved and what the risks are. For instance, funds publish Key Investor Information Documents or KIID or Key Information Documents or KID. These outline the fund's main characteristics and fees. This needs to be read before making an investment. Make sure you understand the business's operations and long-term financial goals if you invest in specific companies. The important point to remember is before you part with your hard-earned cash, be sure you know what you're investing in. The success of your investments will have an impact on your financial situation in the future. Therefore, it's critical to understand the facts before you invest. Make sure you're aware of the level of risk you're taking, the variables that could have an impact on the performance of your investment, and how simple it is to withdraw your money if necessary. Take your time and conduct your own research before making an investment. Never make an investment you're unsure of or if you're in a hurry. Some assets are managed by professionals, which can assist you in coordinating your long-term investing objectives. Read about the benefits of mainstream investments for additional details on these kinds of possibilities for investments. It's crucial to confirm that the company you're working with has approval to offer the service or product that you're purchasing. Using the Financial Services Register, you can determine if the company is authorized. But keep in mind that a company's authorization doesn't imply that everything they do and sell is governed. If you utilize the services of a company that's not authorized to offer them and something goes wrong, you might not be protected and you might not receive reimbursement. Before I go on with the topic, I have a question for you. What word is spelled incorrectly in every single dictionary? Let me know in the comment section your answer. Moving on, it's a good idea to examine your investment's performance from time to time. The decisions you made 2 years ago may not be the ideal ones for you today. Regularly reviewing your investing decisions makes sense, whether you consult with a non-biased financial consultant or do it yourself. Analyze the success of your investments. The attractiveness of some investments you hold over others may change over time because some of your holdings have almost certainly outperformed others. Reviewing what you hold can also help you stay on top of the overall level of risk you're exposing your money to, as higher risk is by no means a guarantee of higher returns. Also, your current personal situation might have changed. Your financial decisions are influenced by a variety of variables, some of which may be particular to your situation. For instance, if you get a new job that pays more, you might have more money each month to invest and be more willing to take more risks in the hope of bigger prospective returns. The best way to make sure your investments still suit your unique circumstances is to periodically assess where and how you're investing. Remember that your financial goals change over time. What you want to accomplish with your investments can alter over time, whether you're trying to accumulate investments for a specific life event, like supporting a significant career shift, or seeking to maximize your pension fund. Next up is to think about the right combination of investments. An investor might guard against substantial losses by including asset classes with investment returns that fluctuate in a portfolio under various market conditions. Stocks, bonds, and cash are the three main asset classes, and historically, the returns have not fluctuated up and down at the same time. When market conditions favor one asset class, it's common for another to perform below average or poorly. You can lower your risk of financial loss and improve the overall investment returns of your portfolio by investing in multiple asset classes. If the investment return for one asset category declines, you'll be able to offset your losses in that asset category with higher investment returns in another asset category. Additionally, asset allocation is crucial because it greatly affects whether you'll reach your financial objectives. Your investments might not generate a sufficient return to reach your objective if you don't take on enough risk in your portfolio. For instance, the majority of financial experts concur that you should likely include at least some stocks or stock mutual funds in your portfolio if you're saving for a long-term objective such as retirement or college. Alright, let's cut to the chase. I know the reason you're watching this video is probably because you want to earn extra income and retire early. If you want to see other content like this, hit the subscribe button. I'll help you become financially literate and guide you on the path to success. When buying large amounts of employer stock or any other type of stock, use caution. Diversifying your investments is one of the most crucial steps you could take to lower the risks associated with investing. Don't put all of your eggs in one basket. It's just plain sense. You might be able to control your losses and lower the swings in investment returns by choosing the right group of assets within a given asset class without giving up too much potential gain. If you invest a lot of money in shares of your employer's stock or any other stock, you'll be exposed to a lot of investing risk. You'll probably lose a lot of money if the company goes bankrupt or the stock performs poorly, and maybe even your job. The upside will take care of itself if the downside is under control. That's what I've always thought. However, minimizing the risk entails controlling the negative. What can protect you from sector risk, which accounts for 50% of the total risk associated with owning a stock? The answer is diversification. The only financial strategy that really benefits everyone is this one. If you can diversify the sectors in your portfolio sufficiently, you won't be affected by any of the several perfect storms that unexpectedly strike us far more frequently than you may imagine. Why aren't there more diverse populations? Many novices don't understand the stocks they purchase. They acquire stocks that are uncannily similar in the end. However, a poorly diversified portfolio goes beyond simple inexperience. Due to the peculiar way that money is managed in this country, many professionals dislike being diversified. You'll outperform virtually every diversified fund if you place all of your bets in one sector and it booms. That's just how the beast is. Then you can sell yourself as a tremendous success, be featured in every publication, and raise money from people who aren't aware of the real risk you're taking on. Both amateur and expert investors are mistaken. Managing risk is the secret to long-term gains, and managing risk necessitates constant diversification. Here's the best part. Both experts and novices detest selling their dogs. They continue to believe and to assume that a stock in decline is moving in the wrong direction. They reason that the weakness or lack of interest they observe is temporary and will pass, and that eventually investors will appreciate the stock's value as the holder does. All great and good, until you need money. Regardless of success, the majority of fund managers have excellent marketing teams that can promote their funds. Managers do receive cash calls despite this, and the dishonest way in which this sector supports just about anyone who runs money if the money runner is ready to reimburse the source of funding. When they do, their propensity to hold onto the losers takes on a sinister undertone. Good stocks are disposed of to support the winners. A self-fulfilling spiral emerges as the bad stocks continue to be terrible. Typically, they keep declining. Without the strong stocks, the fund keeps losing money. Never do they learn my rule. Never use winners to fund losers. People all act in the same way. They can only invest a certain amount of money. They hold on to their losses and sell their winnings rather than accepting the medicine, the loss. Anyone who finds himself in this situation would do well to sell their losses and wait a day. Go back and get them the following day if you really want them. Likewise, I'm positive that you never will. I hope you've learned a lot from this video. Invest in yourself and hit the like and subscribe button below. Tell us in the comment section below if there are any topics you'd like to discuss or make a video on. We would love to hear from you. Thank you for watching. Till next time.